Celsius reported earnings before the market opened on Thursday, and it's hard to argue with any of the results that they reported. 95% revenue growth for the fourth quarter of 2023. As I'm recording, stock's up about 19%, so the market's reacting really positively. This is a very expensive stock, but the company continues to perform extremely well quarter after quarter. So I want to dig into some of the results and just give my thoughts on where Celsius is potentially going, because there's still a lot of growth potential ahead for this company, not only expanding in current markets, like getting better shelf space in some of the big box retailers, but also moving into food service, moving into convenience stores. And the company basically hasn't even started international expansion. That's a tiny portion of the business right now. It's actually growing more slowly than North America. So I'm going to dig through all this today and give my thoughts on Celsius Holding. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the results. I'll just start with a really quick look at what's happening as I'm recording. Like I said, stocks up about 19%. Market cap up to nearly $19 billion. So that's something to keep in mind. This is getting to be a pretty expensive stock, so it shouldn't be very surprising given the performance of the company. But we're now looking at a price to sales multiple that's in excess of 14. So that's really expensive for any company. It's very expensive for a drink company, but we also have growth rates that are nearly triple digits. So this has always been a hesitation of mine, is what do you pay for a company like this? But if they continue to grow at this rate, you can still pay a really high multiple and do really well as an investor. So why is the stock up so much? These are the fourth quarter results. Revenue, $347 million, up 95% from a year ago. You might remember it was a little over a year ago that they started the distribution partnership with Pepsi. So there was cost associated with that. Pepsi invested in the company, and that basically paid for some of the buyouts that they had to do on the distribution side. But the entire idea is that Pepsi is going to be a distributor that's going to allow them to get into more stores, especially those big box stores and some of the food service areas. And that certainly appears to be the case. It appears to be a great tailwind for the company. This is a look at a breakdown of where the revenue is coming from. Like I said, 97% growth in North America. And you can see that $332.8 million of revenue comes from North America, only $14.6 million internationally. So this is where management is starting to talk about moving into new markets like the UK, expanding into Canada, which would obviously still fall under North America. But this is primarily a US company, and their expansion over the last couple of years has really been expanding outside of a relatively regional drink in the US to being a national drink. That's been a huge tailwind. Now the next step is going to be becoming a global drink. So that's where you get to a much bigger total addressable market than what we see today. But these margins are just crazy for a company that is growing this quickly, nearly a 50% gross margin, and then net income of $39.1 million or 17 cents per share. This is one of the things that I think really separates Celsius from a lot of competitors in this space. They don't actually own their own bottling plants or their own distribution. So they're not physically making any of their drinks. They're providing formulas, working with some of their suppliers or co-packers, as they call them, to make sure inventory is coming into the market, make sure that that supply is available to them. But this allows Celsius to grow quickly and still report a profit. Typically, companies that are making a physical product are going to deal with increased needs for working capital. You have to invest in building more manufacturing plants. There's a lot of costs that go into growing a business. But when you're leaning on other people to grow the business from a physical supply standpoint, that allows you to provide these kind of growth rates and still be extremely profitable. So this is one of the things that has really differentiated Celsius and one of the things I like about their business model. Here's a look at some of their sales growth trends. You can see that the fourth quarter is always a little bit more of a difficult period for them. One of the reasons for that is that the shelf space is really important. And in the fourth quarter, people are using shelf space to show more holiday goods and things like that. So a retailer isn't going to necessarily put Celsius front and center the way that they are in the summer months, for example. So that's one of the reasons that you see this growth rate come down sequentially. So that shouldn't be a big surprise. We knew that was coming. And then we're expecting more growth to come in the first and second quarter. So just something to keep in mind. And in a second, I'll show the trailing 12-month trend, which really shows a much smoother growth rate. If you go down to the balance sheet, this is another piece of strength for Celsius, $756 million in cash on the balance sheet, and there's no debt. So really solid balance sheet for Celsius. Just takes a little bit of that risk off the table that some companies have. So business model differentiation and a really solid balance sheet. That's a great combination for a company. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Here's a look at the chart I mentioned earlier. This is the trailing 12 months revenue. So it just smooths out some of those revenue blips that happened in the fourth quarter. You can see that revenue has just steadily been growing quarter after quarter, now $1.3 billion on a trailing 12-month basis. And just to give an idea of what investors were expecting, the average estimate for the full year for 2023 was $1.30 billion, so beat that by a little bit. And then for 2024, the consensus estimate or average estimate is $1.80 billion in revenue. So about a $500 million increase in revenue. So that implies a slowing growth rate from 95% to about 40%. It's very possible that Celsius slows growth to that rate, but I think there's a lot of opportunity to potentially grow much faster, especially as you start adding in some of these food service businesses, as Celsius products move to the front of some of the big box retailers in particular. And then as we start to add in international revenue, I talked about that earlier, that's a very, very small percentage of the company's revenue. So just getting into some of these new markets with the tailwinds that Pepsi can provide, that could be a growth driver, at least later on in 2024. Now, there's no doubt this is still an expensive stock on a price to earnings multiple on a next 12-month basis. PE ratio is 70, enterprise value to sales is 9, so you're coming underneath 10 from a price to sales perspective, but that's still extremely expensive. But the upside is that Celsius continues to perform quarter after quarter, and this is one of the things that I keep coming back to with this business, and Monster did this over the course of about the last 20 years, is that it's really hard for investors and analysts to model a company that's going to grow 40, 50, 100% per year for a long period of time. And that's how you get this kind of outperformance. I mentioned that that analysts are only expecting about 40% growth in 2024. Well, what happens if we see another 100% growth in 2024? The stock's going to do extremely well again because those expectations are lower. So this is what continues to happen with Celsius. And like I said, they can continue expanding the business because they're not capital constrained. They're not supply constrained like a lot of physical companies are. They're leaning on their suppliers to be able to provide product to market. And now with this distribution partnership with Pepsi, we've seen a lot of Pepsi's legacy products become less and less popular. One of the most popular products is Celsius drinks. So they're going to want to lean into that growth, fueling growth even more. So I think there is a lot of potential ahead for Celsius. The product just hits so many great markets. Yes, it fills this energy drink market, but it's not a traditional energy drink like you would see with a Red Bull or a Monster. So it's accessible to more consumers. Management has talked about this a lot. There's a much bigger female contingent that's buying Celsius than traditional energy drinks. Personally, I think it's just more accessible to people who want to have some sort of beverage, but not necessarily a Red Bull or a Monster, even with something like dinner. That's why it's working at places like food service. So it's really competing with sodas and energy drinks. That's just a phenomenal position for Celsius to be. Provides a lot of growth potential. I think this is a company that can continue to grow at an extremely high rate, maybe not 95% in 2024, but a growth rate of 40, 50, 60% can make this a phenomenal investment, despite the fact that it's still a very expensive stock. So this is a stock that I own that I'm just going to continue holding as long as Celsius keeps crushing each quarterly report, which they did again today. What do you think about Celsius? Is it a stock you own or that you've looked at in the past? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.